Coming up on Business Incorporated. South Africa's inflation rate quickened to 6.5% in May from 5.9% in April. The World Bank pledges $2.3 billion to tackle food insecurity in Africa. And Ghana receives $450 million from African Trade Insurance Agency for cover on trade-related transactions. Hello, welcome to the program. I'm Ladi Williams. First of all, let's take a look at how your money is performing at intraday in the African continent. It's mostly negative. The trading sessions we're seeing across markets we track. Nigeria's main index still in the green from yesterday's positive close, up marginally by 0.08%, hanging on to the 51,000 points level just by a thread. Meanwhile, South Africa's benchmark index is down over 1%. Elsewhere, Egypt's index traded lower by 0.41%, while the Nairobi Stock Exchange closed Tuesday's trading session negative, down 0.98%. And over to the Middle East, where most of the equities we track there are all in the red. The Abu Dhabi index dropped lower, over 1.5%. Also, Dubai index was down almost 1%, still within the region. Saudi Arabia's index dived 1.88%, while the Qatari index dropped 1.10%. We're seeing big losses across board in those markets. And over to Europe now. It's all about warnings of economic crisis. We have Chris Koba right there with the details. Great to have you, Chris. Well, Germany's finance minister is warning that the country is heading towards a serious economic crisis amid the fallout of Russia's war in Ukraine. What are the issues that are most concerning at this time?
There is a number of factors that have the government concerned: rising energy prices, a growing shortage of gas coming from Russia, strained supply chains, and a general increase in the cost of living as food prices are surging as well. And those are the individual factors that, as the finance minister Christian Lindner believes, could be leading to quite a worrying situation in the weeks to come. He says that Germany could be facing up to 5 years of scarcity, and there's a real chance of a serious economic crisis evolving from that. The government's top priority should be to tackle inflation, Christian Lindner from the business-friendly Liberals says, not just because energy costs are galloping for companies, but also because a growing number of people are having difficulty paying for their everyday expenses. Inflation is mostly driven by high energy prices, and in the past days, Russia has been reducing the flow of natural gas to Germany, officially citing necessary repair work on one of the major pipelines. But leaders in Germany believe it is a move intended to punish the country and its EU partners for their support of Ukraine. The measures have also caused prices at the gas market to rise further, and Germany faces a certain recession if already faltering Russian gas supplies completely stop, an industry body warned this week. Annual food inflation in Germany accelerated to over 11% last month, the highest rate since at least 1992.
Right, Chris, but how does the government plan to, alleviate the economic pain for German citizens?
It has already launched initiatives to temporarily cheapen gas and public transport, measures intended to ease the cost of mobility for people. The results have been mixed, but political leaders from a number of parties have been saying that there needs to be more support for people that are facing rising costs of living. There have been calls by trade unions, for example, to increase the annual tax exemption amount, arguing that negotiating higher wages, as unions normally do, shouldn't be the only measure in trying to tackle inflation during these times. One of the leaders of Germany's biggest opposition party said that communities should provide an example on how to save energy by limiting heating, cooling, and lighting in public buildings. Now, that demand coming on the heels of Germany's vice chancellor calling on citizens to reduce energy consumption. Among the government in Berlin, there's been talk about cash handouts to citizens, but these talks haven't finalized. The idea has the support of the Social Democrats and the Green Party. It has also earned praise among economists who say this would be the best way to support low-income households. The Liberals, which are coalition partner number 3, have been reluctant to support the idea, as they feel they have been voted into government for their image of financial prudence, and there could be more friction with the Minister of Social Affairs saying he doesn't see the capacity to ease financial pressure for all households, meaning that those with higher incomes would be excluded in favor of those making much less. But it is these mostly more affluent households that traditionally cast their vote for the Liberals, which in recent regional elections have been hammered for their performance on the federal level. And with the Liberals struggling so far to find their right position in this crisis, there certainly is potential for more friction within the ruling coalition in Berlin.
Potential for more friction there. Well, most global equities markets are not looking at the best right now. How's it looking in Europe?
It is oil prices that certainly have been setting the tone today. They plunged more than 5% as investors grow increasingly worried that demand for the commodity will take a hit soon amid the increasing risk of an economic slump. Crude has soared in recent months to multi-year highs on concerns that tight supplies caused by the Ukraine war will not be enough to meet demand from reopening world economies, particularly in China. But central banks have been forced to ramp up borrowing costs as the rise in energy cost has helped send inflation soaring. That in return has fanned concerns that economies around the world are heading for a recession, sending chills through crude markets today. And with crude prices, equities are taking a dive as well. The DAX in Frankfurt losing more than 2% in the early parts of today's trading session.
I guess risk off is still on the table at this time. Thank you so much, Chris Koba, right there in Berlin. All right, now let's head on to the UK. We have Juliana standing by right there, and the massive global elephant in the room, inflation, still biting hard right now globally. Let's see how hard it is right there in the UK. Great to have you, Juliana. So it's a fresh 40-year high. It's talking about inflation. What are analysts expecting from the Bank of England?
Good afternoon, Laddie. I think some economists are expecting a more aggressive push on interest rates rising here in the UK. As you said, this morning we got data from the Office for National Statistics showing, unsurprisingly, that inflation had surged to 9.1% year on year in the month of May. And I think the central bank was certainly under significant pressure when last week, Wednesday, Jerome Powell in the US Federal Reserve had their most aggressive rates rise since 1994, increasing it by 75 basis points. Now, Jerome Powell is going to be speaking in Capitol Hill over the next couple of days, and I certainly think UK economists are going to be listening pretty intently at what he's saying, because, of course, America is the world's largest economy, and how they try to tackle surge in inflation is going to be taken pretty seriously. Back to here in the UK, that 9.1% does show that, you know, consumers and workers' money isn't going as far as it used to, and that 9.1% is the highest rate of inflation in any comparative economy. So clearly something has gone wrong, and I'm pointing the finger at the central bank, at the Bank of England and Andrew Bailey, asking them to do more. This interest rate rise last month was the 5th consecutive rate rise, but some say it wasn't enough. 0.25%. Why? When you could have gone higher at a 0.5%. Now that's what 3 Monetary Policy Committee members did vote to do twice in a row now. It hasn't been a unanimous decision, but as we know that things are going to be getting a lot better, some are asking the Bank of England to get involved now. so we can avoid inflation reaching 11 or even 12% by the end of the year.
Right, that's borderline double digit we're looking at this point. But how are the markets reacting to this figure?
Well, no surprises. So the UK blue chip index, as soon as the ONS released that data, plunged by more than 1%, and it stays that way at intraday. The FTSE all-share is down by 1.35%. The FTSE 100 is down, and the FTSE 250, the domestic market, that's down by over 1.5%. Also, as well, the British pound is not faring too well at intraday. It's currently down against the US dollar, against the euro, and against the Japanese yen.
And trust investors there waste no time in selling off. But a new research claims that Britain's cost of living crisis is being made worse by Brexit, dragging the country's growth potential and, costing workers hundreds of pounds a year in lost pay. Tell us more about this.
Goodness me, there's so much gloomy data at the moment. Brexit and talks of Brexit just make issues much worse, because according to the Resolution Foundation, which is a think tank, just having a look at how households are surviving in the UK, they do say that Brexit is making life significantly harder for people living in the UK at the moment. I think you can just have a look at what's happening, have an idea how that's happening. We did hear from the Ryanair boss earlier this week saying that one of the reasons why tens of thousands of people are struggling to get on a flight at the moment is because of the bureaucracy around Brexit. So many European workers that want to work in this country and have the skills to do so are not being able to do that because they don't hold British visas or they don't have the right documents. That is having a knock-on effect on the labour market. If you speak to anybody working within farming, horticulture or agriculture, they are having a real issue in surviving through peak seasons, because so many workers that would typically come over from Europe to do the jobs are just not able to do so. And many of these jobs that are being advertised, according to some, British workers just feel as if they're too good to do it or cannot be bothered to do it. So this is having a knock-on ramifications. Of course, there's also the issue with the Northern Ireland Protocol and the fact that the Foreign Secretary Liz Truss wants to rip up the withdrawal agreement because things are not working for Northern Ireland businesses. And this is all having an impact on people's lives and how people are coping with it. We did have Prime Minister's questions, which just wrapped up about an hour ago in the House of Commons. A lot of backbench MPs, as well as the opposition Labour Party, did put some of the suggestions and the statements by the Resolution Foundation to the Chancellor. Of course, this was batted away, but considering we are going through the worst living crisis in 40 years, I don't think the questions about Brexit and whether or not it's making lives for Britons any harder is going to go away any time soon. So I think it's definitely something we'll be talking about for months and months to come, Laddie.
Right, all about surviving the rising costs of living right now. Thank you so much, Juliana. All right, now let's take a look at what's happening in Asia. We see shares in the Asia-Pacific region mostly traded lower today as economic fears continue to weigh on the market. Chinese markets tumbled. Hong Kong, the Hang Seng Index fell 2.56% to close at 21,008 points. The Hang Seng Tech Index dropped about 4.37%. Alibaba slipped 4.16%. And the Shanghai Composite declined 1.2% to close at 3,267 points. While the Shenzhen component closed down 1.42% at 12,246 points. South Korea led losses, with the Kospi falling 2.74% to close at 2,342 points, and the Kosdaq dropping 4.03% to 746 points. Meanwhile, Japan's Nikkei 225 slipped 0.37% to 26,149 points at the close, while the Topix was down 0.19% at 1,852 points. All right, we'll take a break now. While we come back, more stories on the African continent. Do stay with us. Welcome back. Now we're still drilling down on the markets. The U.S. stock index futures fell early today after the major averages jumped in regular trading hours, attempting to claw back some losses following weeks of selling. Futures contracts tied to the Dow Jones Industrial Average fell 420 points, while the S&P 500 futures declined by 1.34%, and the NASDAQ futures fell 1.47%. Well, our correspondent, Mario Bird, has details of yesterday's close.
The U.S. stock market rallied on Tuesday after one of its worst weeks since March of 2020. The Dow Jones was up by 2.14%. On Tuesday, the S&P 500 was up by 2.44%, and the heavy tech NASDAQ was up by 2.5%. Many investors will be watching to see what happens with the congressional testimony by the Federal Reserve Bank Chairman Powell to see if he is serious about increasing interest rates by 0.75 percentage points. This could be detrimental to the U.S. economy, but may stabilize inflation. Many investors will be watching as they have offloaded many of their riskier stocks, being preventive in case the economy and the stock market takes a little bit of a hit toward the end of the week.
That's our correspondent, Mario Bird, with yesterday's close right there in the U.S. Now, moving on to our next conversation. Well, it's all about moving Africa towards a digitally inclusive and rights-respecting continent. That was a major focus for the Paradigm Initiative. We'll discuss the outcome of the forum now with Adeboye Adegoke, Senior Program Manager at Paradigm Initiative. Join us right here. Great to have you.
Thank you for having me.
Yeah, so what would you say are the limitations to Africans fully taking advantage of digital innovations?
The limitations, or if you like, the bottlenecks are many. First would be, the infrastructural challenges that Africa has to grapple with because digital technology thrives or rides on basic infrastructure. And when I say basic infrastructure, I mean like light, electricity, and the quality of the internet service that we have in Africa. As a matter of fact, we still have a problem or challenges with internet penetration across different countries in Africa. So that is a big challenge for innovation. But besides this, we also have challenges in terms of understanding of technology at the policy-making level. It's also a challenge that those who make law
All right, seems we have a little glitch there with Adeboye right there. He was talking about... Adeboye, I don't know if you can hear me now.
I can hear you very well.
Okay, you can finish your thought that we had a little interruption with the network there.
Oh, okay. So I was making the point that basic infrastructural challenges are a huge barrier to digital innovation on the continent. And that in addition to that, we also have challenges in terms of policy making. To make decisions regarding policy, mostly people are unfamiliar with this technology. The policymakers grapple with understanding technology and in terms of lack of capacity to make the right policy that can unleash the digital potential for digital innovation on the continent.
All right, so but what do you think governments and regulators can do to allow, freedom with digital usage in Africa?
We need to take the subject of connectivity very seriously. The digital divide is still very, very huge. Almost half of Africa is still not on the internet. So we need to prioritize that. African governments need to prioritize that and ensure that we continue to deepen expansion. If you look at the numbers across Africa, it's not encouraging. I mean, you have the best numbers from countries like Nigeria, where we have close to 60% penetration. But if you move towards Central Africa, we are looking at about 20% on the average. Even if you look, if you move outside of Central Africa to East Africa, I mean, they have decent numbers to between 30 and 40. But if you go to Southern Africa, apart from South Africa that has about 50 something, most of the countries in Southern Africa, some of them even have, like Malawi, for example, has about 30% penetration. So you can see that these numbers are not encouraging. So that has to be solved and taken on, head on, and ensure that you have internet penetration across the length and breadth of the continent. But once we get that out of the way, we can then begin to talk about the policy issues that seem to stand as a barrier. Because if you look at policy response to digital technology in Africa, unfortunately, it has been much about taxation. It has been much about fighting the negative use of digital technology. So you see cybercrime laws that have very big provisions that unfortunately can even close that digital space up. So we need to address those issues and ensure that while we're trying to, cure the headache, we don't throw the baby out of the bait, with the bathwater. So these are some of the things that African government, and more importantly, African government also needs to work together in terms of coming up with best ideas. They should not work in silos. But lastly, we must also rely a lot on the expertise that exists outside of the government, because the kind of capacity required to drive digital innovation, digital prosperity in Africa doesn't exactly exist in government. So government must rely a lot on collaboration, multi-stakeholderism, trying to leverage expertise that exists outside of government.
All right, before I let you go now, briefly, do you think taxing big tech companies is the right move, by most African governments as they're proposing at this time?
I mean, first thing, taxes are legitimate. In other words, it's legitimate to tax businesses, but we need to contextualize this. We cannot tax our way out of, our digital advantage right now. We must tax appropriately. I said earlier that the major thing or challenge that is facing us is the need for us to ensure that we expand participation online. Make sure that we bring the rest 50% of Africans that are not online. Make sure that we bring them online. Now, when you tax big tech at this point in time, especially those who provide such services, you are even making it difficult to get more people online, because it then means that the cost of access will increase. We have challenges with affordability. So that is why we have to contextualize the conversation around taxes. Like I said, taxes are legitimate, but then we must be very careful in terms of how we introduce those taxes, for example. Okay?
All right. Thank you so much, Deboye Adegoke, Senior Program Manager, Paradigm Initiative. Thank you so much for giving us your perspective on the program.
Thank you for having me.
All right, now let's take a look at what's happening around Africa now with some of our stories we have here. We see South Africa's inflation rate quickened to 6.5% in May from 5.9% in April, the highest reading in 5 years, and breaching this upper limit of the central bank's target range of between 3 and 6%. Statistics South Africa show that the consumer price index increased by 0.7% month-on-month in May, and see transport prices increased by 15.7% year-on-year, with the price of petrol almost 27% more expensive than it was in May 2021, and diesel over 45% more expensive than in May 2021. And the World Bank approved a $2.3 billion program to help countries in Eastern and Southern Africa increase their ability to deal with spreading food stress that's expected to affect about 66.4 million people in the region by next month. Funding is meant to ease food system shocks spurred by droughts, conflicts, and pest and disease outbreaks that have been exacerbated by Russia's invasion of Ukraine, and that's according to the Washington-based lender. Beneficiary countries in the first phase are Ethiopia and Madagascar. About 22.7 million and 7.8 million people are food insecure, respectively, due to drought. World Bank said the financing package for this phase amounts to about $788 million and is expected to benefit 2.3 million people. And Ghana secured $450 million African Trade Insurance Agency-backed insurance cover for projects and trade-related transactions in various sectors of the end of May 2022. An insured portfolio of trade and investment across Africa, valued at $6.6 billion. That was in 2021. HCI, multilateral insurer, continues to serve in bridging the gap by providing risk insurance on the African continent between sovereigns and investors, as well as creditors and suppliers. And that's it on Business Incorporated. Thank you so much for watching. I'm Ladi Williams. Bye for now.